Hello and welcome to This is Property. You're with John Pidgeon. We're wanting to talk about the interest rates, and at the minute they're sitting somewhere around 6 to 6.5%, depending on the structure and the ins and outs of it, investment versus owner-occ, etc., and just how to handle that. And maybe it's a mindset thing, but it's definitely a physical thing, money coming in versus money going out. So I really want to unpack this and understand, first of all, what's happening in the future in respect to interest rates. No one knows, but we can forecast a lot of things. So let's unpack this beauty. This is in your wheelhouse, isn't it? Like interest rates and lending. And for those who are first-time listeners, Rach is the CEO, director, owner, founder of Sphere Home Loans, who's a proud supporter of the show and has helped many listeners around the country over the years. So 6% interest rates, they're pretty standard when we look back in the last 50 years. Like it probably averages around 5 to 6 to 7% over the journey, doesn't it?
Yeah, it does. But I think it's pretty tough for people who've invested maybe in the last 10 years. I think this is the first time a lot of these investors have seen rates like this, and it's hard.
Yeah, it is.
Yeah, it's a daily conversation for us of how am I going to hold this portfolio that I've worked so hard to build when the rates are at this level? Yeah,
that's right. And there's many different versions. Well, everyone's got a different version of this. Whether they're first-time investors, whether they're just but whether they've got their owner-occupier and that's what they're concentrating on, whether they are looking to get into the market and they're doing the sums and freaking themselves out, whether they're oldies like me that have been through the highs of 7, 8% down to 2% and back up to 6 again. So do you think a lot of it comes back to mindset?
I think a lot of it is mindset, but there's also the facts that it just costs money to hold a property at the moment. I think more than ever, people are looking at ways of how to reduce those costs and how to make property more affordable.
Yeah, so that's a really good point. It's as I said at the top of the show, it's money in versus money out, and they're just the facts, aren't they? So on one hand, you've got people saying capital growth, the property doubles in value every 10 to 12 years and you'll be rich and successful forever after. But on the other hand, it's like, well, if I can't afford that capital growth enriched property, it's no good to me anyway because I'll have to sell it. So we always talk about this dance between growth and cash flow or yield.
Yeah, and that's right. Obviously rates have gone up. But so have rents. Rents have gone up as well, quite substantially over Australia. Sorry to the renters. That's it's been a rent rise. But other things have gone up as well. It's not just interest rates holding, sort of hitting investors at the moment. We've got council rates, land tax, insurance. Property insurance has gone up nearly 30%.
Yeah, it has, hasn't it? I got a nice little surprise in my inbox last week actually for one of my properties, and I think it said like a 27% increase or something on last year's premium. And when I actually went and did, for once in my life, I went and did some research in respect to changing insurance companies, and the opposition, as we call them, were higher than that again. So it gives me comfort that I'm with the right company, but it's a big increase like when you take that. And I think the thing that's working against everyone at the moment, and don't want to sound like this is all doom and gloom because it's definitely not, but wages haven't increased at the rate that living expenses have they?
No, and that's not just for investors, that's across the board. Australians we're dealing with a huge cost of living crisis. Yeah,
not many people can sit here and say, oh, my income's gone up 27% last year.
No.
So that's got to be appreciated. But any case, I think we look at a version that's going to work for us. There is a way through with the right mindset and approach. And I suppose today we're going to give listeners that already have property or wanting to get into property some tips and tricks that maybe prevent them from tripping up along the journey.
And just making it more affordable to hold in these times when the rates are a little bit higher.
Yeah, all right. So I'll let you kick off with not any particular order. What's one tip that you would maybe give these people? What's one tip that you would give everyone listening as to how to deal with this sort of situation of 6% interest rates?
So I think the big one is actually, we talk about interest rates, but I think the repayment is more important than the rate.
Yep.
And we're regularly reviewing investment portfolios where people are saying, oh, can you review my portfolio for the rate? But a lot of the time we're looking at these portfolios where there's principal and interest repayments being made on investment properties. And that's great, during those 2% times where you can afford to do it. But interest-only repayments aren't necessarily a bad thing. They make property to hold affordable.
Yeah.
So I think if I had a portfolio, if I was giving advice to somebody with a portfolio, the first thing is to review your lending and check that the ones that should be interest only, anything that's investment is interest only. Even those that are actually secured against your own home, that might be the deposit for your investment property, even though it's secured against your own home, if it's for investment purposes, just tweak that and make sure everything's interest only, making it more affordable to hold.
No, I love that because, again, coming back to that M word of mindset, a lot of us go in just organically wanting to pay down debt, regardless of whether it's good, bad, or middle. Like it's just a mindset that maybe we're grown up with, or maybe it's just that's what we want to do, which is cool, but financially it might not make sense if we're going to want to build a sizable portfolio, or we're wanting to save money on the side, because we know that once we pay down property, the only way we can get it out is to either sell it or it comes back out as equity. So, yeah, that's a really good point. So going from P&I to interest only, because you're in the game of this, how easy is that to do? I know, like, if someone wants to go and pay P&I, the bank's never going to stop them.
Never. And it is – so during I guess 5 or even 10 years ago, it was really easy to change to interest only. It was a phone call to the bank to change it to interest only.
I remember when I first started, they'd never even ask you. Like, there would never be a period. It used to just be interest only and that was it.
Yeah.
Like pre-GFC I'm talking.
Absolutely. And I remember the banks used to do 15 years interest-only periods.
Yeah.
I've still got some clients that are sitting on those.
Yeah.
But if you're paying principal and interest and you want to go to interest-only, it's a full credit decision. So you do need to give all your pay slips and all your paperwork again to be able to extend that to interest-only. And if you're going to be doing that, it's obviously worth reviewing what that rate is interest-only comparatively to the other lenders. So it is a paperwork exercise, but it's well worth that exercise if it makes that property more affordable to hold.
So I'm just looking at a scenario now, P&I on a $620,000 loan at 6.21%. Is that fair as an investment loan?
Yeah, I think that'd be fair.
Yeah. So the repayments, principal repayment on that is $7,367 a year. So majority of that can go back in someone's pocket if they're paying interest only, but the interest only amount of the loan is going to be slightly higher. The rate, is going to be higher, isn't it?
Yeah, depending on the lender and depending on the structure, they tend to sit a little higher, but sometimes they don't, just depending on, I guess there's people that have changed from principal and interest to interest only recently that have managed to keep the same rate because their rate sort of crept up over time.
Right, so after tax in this situation, this scenario, the after-tax holding would be $2,051 per month that this client would have to come up with, or this person.
Yeah.
If I change that to interest only and keep the rate at 6.2, the after-tax cash flow per month is $1,454.
Yeah, it's very different, isn't it?
Right, so that's when I went to school, $600.
Yeah.
Back in your pocket by just changing from P&I to interest only.
Yeah, and I understand the mindset of I want to pay this down, and that's great. But if it stops you holding the property, or if it impacts your lifestyle that it's uncomfortable to hold, then that's not really what we want from holding property. We want it to be able to complement our life, not take away all our fun.
Yeah, correct. So if I change that interest only to 6.4, which is that 0.2 higher, we're now $1,553. So we're still $500 better off.
Yeah.
Yeah, look, it's not a no-brainer, but it's not far off it, is it, in respect to that P&I versus interest only? conversation if you feel that it's all getting a bit tight because the interest rates have crept
and
up.
even when rates were low, I mean, I would have encouraged clients that $700 difference that you were talking about to pay off that property. I still think that should have been directed on their own home, not the investment property.
Yeah, and that's the conversation for another day, isn't it? If I've got my PPR, we should be paying that down
absolutely
first before anything else in our life, other than our bad debt, of course. But all right. So no, that's a good one.
Yeah, I'd say that's my top one.
Yeah, it could almost be number one for the show, to be honest. Like, it's a pretty big one because the mindset of wanting to pay down debt is valid and cute, but when it comes to dollars versus cents, makes sense. So one thing that I had was and I know a lot of people have already got property, so it's too late to say, well, before you go and buy, do this, right? But just have a really good cash flow management plan in your personal life. Know what's going in, know what's going out, and know what your savings rate is per year, not per month. And also on that, I talk to a lot of people who say, oh, John, I save 30 grand a year. I'm like, okay, so when you wake up in 12 months, will you have 30 grand extra in your bank account? Oh, no, sometimes I might have 10 or 15. I'm like, okay, where's that other? I went on a holiday. Okay, scrap all that. It's not 30, it's 15. Still have your holiday, but be realistic with your plan. Because when these little things come up, i.e. interest rates go from 5.5 to 6, and that extra $500 a month comes out, where are we getting that from? And I think it starts right back at the bare bones foundation of our life to say money going in, money going out. I've factored absolutely everything, Christmas Day, holidays, school fees, whatever it is in your life, and know that you can comfortably save that amount per month, every month for that 12-month period.
Yeah.
Gives you comfort, gives you confidence, doesn't it?
It really does. And just on that budget part of budgeting and having a good plan, I think another key thing there would be when you've got a different offset account for each property that you're running, it's a really good way to see what each property you're putting into it.
Yeah.
Or having a different cost analysis for each property. Because I think sometimes people come and say, well, it's really expensive for me to hold these properties now. But when we actually break it down, it's their cost of living that's gone up. The properties are actually taking care of themselves. So it's nice to know that too with your budget.
Totally, yeah. So personal and business, like we call property investing a business, really, if we're serious about it. Personal and business need to be separate, as you mentioned there, and the offset accounts are a good way to distinguish the difference there. Yeah. Okay, no, it's good. All right, another one?
I would say, and I've actually noticed a lot of people are unaware of this one, and I just think it's worth mentioning, which is the PAYG withholding adjustment.
Yeah.
So traditionally, I think when rates have been a little bit lower, I've always encouraged clients to not do this and to actually get that tax return at the end of the year and pop it straight onto their home loan. But I think as more clients are coming in and saying, I'm actually really struggling week to week to hold these properties, I think we're talking about this more. And just for those of you who don't know, a PAYG withholding adjustment is when you actually talk to your accountant and say, well, this is what my property is going to save me in tax a year, and getting your payroll to adjust that each pay. So, your property might be costing you $300 to hold a fortnight, and then you get, 100 of that back at the end of the year. But you can adjust that so you're not paying that 100 each fortnight, and you're actually getting it into your pay.
Yeah, and I find with that, a lot of people, number one, don't know about it.
Yeah.
And number two, accountants are reluctant to endorse it.
Okay.
For obvious reasons. And the obvious reason is we get the money now instead of later. What a lot of Australians likely to do with that?
And that's where I think about those offset accounts. So, you've got an offset account for each property. If just say you've got one investment property and you're getting a $200 a fortnight buffer that's coming in to help you hold that property, those funds have got to go to the account that's allocated for that property. So you've still got to put your top up in each fortnight, but it would just lessen that cash flow. Again, if you're not doing it with great habits, it's not going to be effective.
No, absolutely.
You've got to be disciplined to do that.
You do. Yeah, you've got to really have your ducks in a row. Otherwise, it could end in a disaster because Exhibit A might be, right, I get my $100 a fortnight back now instead of the $3,500 at tax time. I get to tax time, I've spent all that on stuff that I shouldn't have, and I don't get a tax return at all. Now I'm out in the water with no clothes on.
And also probably not the thing for people that don't have a regular income, because if you really need to know your numbers to do that. You need to know what your income is and what your what your net income position is going to be after the investment property.
Yeah.
So if you're going to do that with, if you're self-employed and your income's going up and down, you can't even forecast those figures.
No, that's right. The good thing about property is you can forecast it, can't you? You know exactly what the costs are that are coming out. You know the rent that's coming in. Now there's variations around that, vacancy rates, interest, repairs and maintenance, things like that. But generally, you've got a figure that you can forecast for and you can plan out. But yeah, so if you're sitting there saying, well, I might chat to my accountant about it as an option, obviously be disciplined in the conduct of that, but be prepared that the accountant might be very hesitant to do that as well.
I actually asked my accountant to do a scenario for me of just how this was going to look. And he has said that he has had a huge rise in these in the last 12 months.
I'm sure.
And that is because people's buffers are running out and they're looking for options.
Yeah.
So he even said, I've seen a lot more people do this in the last 12 months.
Yeah, there you go. All right. Okay, we'll take a break and we'll come back. I've got a beauty. Let's do it.
This is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
Okay, Rach, you knew this one was coming. It's my favourite.
I already know what you're going to say.
You know what I'm going to say, don't you? So this is for someone that's sitting there that has multiple properties or at least one property that they can pull equity out of. So generally when we're buying our second property or a third, we can use cash or equity. Equity if we've got it in our first home, which is the difference between the loan and the value. Bank won't let us take all of that, but they'll let us take some of that, or our cash from our savings. Now, if we're going to buy our second property using equity from our first home, and we want to use equity from that first home, we can grab an amount from the bank and they will say, right, this is how much you can take. And they'll also say this can be your maximum purchase price, right, or total lend. Once you've got that equity sitting there in an account, it's fair to say you can do whatever you want with it, right? You can go and buy a pair of shoes or a jet ski or a boat, but normally when we're talking property, we want to use it for our deposit.
Yeah.
And stamp duty and associated costs, legal costs, buyer's agent fees, etc. Right. So is it okay to say, well, I'm going to take $5,000 of that and allocate that towards some holding costs of that property in the first year, knowing that I'll get some sort of tax return, and then we can put that money back into there. Not all of it, but obviously some back in there.
Yeah, so there's no reason you can't do that. And, I guess the buffers are more and more important as we talk about these costs to hold as well.
Because when we build a portfolio, there's more things going on. There's more variables. There's vacancies with the number of properties. There's interest rates across the whole board. And ideally our rents are increasing each week. So it is like running a small business. So we need to really manage that well and understand, as you said before, each property in isolation, what's it costing us to hold, if anything, and then after tax, what's the fallout of all that. But if we've got that little buffer And whether it comes in the form of cash or equity doesn't matter, or does matter from a tax point of view, but conceptually we've got an amount there that allows us to sleep at night.
Yeah.
If the alternative was, well, I need to give up on school fees or a holiday or whatever over here in my personal life, I can use some equity from my existing first home.
Yeah, and you can. There's no rule that says you can't borrow for that buffer. Yeah, and whether it's 5,000 or 50,000, you can borrow as long as your income and your equity's there. You can have that money put away for that time.
Again, that word discipline comes back into it to say don't just grab it and use it for a night out with friends and family. Don't go and use it for an upgraded car or whatever it might be. It's got to be used for the purpose of growing your portfolio and holding your portfolio.
I think before somebody were to do that, I think you really need to understand your own psychology with money.
Yeah.
Am I able to leave that there for 2 or 3 years' time if I need it to hold this property, or would I be tempted to use that for something else?
That's right. Yeah. So, the discipline needs to be there. But I think when you're talking to your mortgage broker, you might have those conversations around, righto, my max price is $600K that I'm going to buy in at. I'll need 10% plus stamps. There's $90K, give or take. I'll need another 10 or so for incidentals, but I'll also grab another 10. So mortgage broker, can I release 110 or 120 in equity and have it sitting there and use it as I need to for that next 12 to 18 months?
Yeah, and noting that, let's say you did need 125 for the deposit and costs, and let's say you did borrow 150, and let's say that 25 was sitting in the offset account that you've got allocated for that property, you're only paying interest on what's drawn. So you're not paying for that money until you use it.
Yeah, so a quick calculation of that is if you take an extra $20,000 and you're paying 6.5% interest on that when you draw it down, that equates to $25 a week in interest.
Yeah.
Right. So if you can't get your head around the fact that you're paying the bank an extra $25 a week for the privilege of using that extra $20,000, then it needs to come from your personal life over here, your savings, your after-tax money.
Yeah.
We're putting all these things in place so that we don't have to get to the stage where we sell an asset prematurely.
That's right. And that probably gets us to the next one, which is make sure you have the right properties in your portfolio. And I think more than ever, I think when rates were 2% and 3%, and a lot of people are just thinking, oh, great, all properties are great properties. But I think when rates get to where they are now, people are really looking at, do I have the right mix in my portfolio? Is that particular property costing me more than I can afford right now? And was it the right property to start with? So I think if people are picking a property to sell in their portfolio, they're looking for the worst performer.
Yes, yeah, the lowest hanging fruit usually comes to mind, doesn't it? It's either not performing from a growth point of view or it's burning a hole in our pockets with cash flow.
Yeah. And if I look at what I would call the property that I put the most into each week, it's also my best performer for equity growth. So I'm happy to keep that going. But if it wasn't, I'd soon be losing that.
And that's what we need to understand. And I've never bought into the full concept of negative gearing. Like I don't like losing money essentially. Yeah. Like if you're negatively gearing a property by $30,000 a year and you're only getting 15 of that back, you're still losing $15,000.
You are.
But if your property on paper is going up by $50,000 a year, then it's a
You're in front.
It's a net win. Yeah. And generally around the country with residential property, the best performing properties are the lowest yielding properties, aren't they?
Yep.
So you are going to put more money into those properties than least performing properties. But there are some lemons out there that are both. They're high in they're low in capital growth, but also low in cash flow, which hurts.
And sometimes they can look appealing at the start because they're actually, they've got that lower entry point sometimes, and you think, oh, that's actually going to be a cheaper property to buy. But cheaper isn't always lower cost to hold. No. And that's what we need to look at, not just the cost of getting into that property, but what's the cost to hold that property.
Yeah, that's absolutely right. And I think you were saying something before we came on about a property that someone had in Sydney where over 7 years, I think you said?
7 years.
Yeah, it had gone up like 30 grand.
Yeah, it was a unit somewhere near Ryde. And I just was, if I've held a property for 7 years in investment property, I'd want a little bit more growth than that.
Yeah, no, 3, what's that? 7 3s are 28, 3 grand a year. So it's a good chance that property would have cost more than 3 grand a year to hold, which is a big concern. So we've lost some money on that, unfortunately. All right, so the right properties in the right portfolio, essentially, is what you're saying there.
Yeah, and you might have a mix where one can prop up the other, but they've got to...
So that's great for someone that hasn't got any properties right now, but for those listening in that have got a few properties and are saying, well, yeah, that's great, but now I've got these properties that aren't the right mix, what do I do? So, again, capital growth and cash flows are giving us one or the other, or ideally both. Or will it give us both in the future?
Yeah, and I would say, if there's something that isn't performing and it's the wrong one, should you be scared to get rid of it? Is it a failure to just go, that's not right, I'm going to let go of that one and move on?
Sometimes it's an ego thing, isn't it?
Yeah.
It's like, oh, no, look, I don't want it to fail because I'm a sophisticated investor, right? And I will hold on to it just for the ego component of it, whereas I've got to look at the black and white numbers and say, well, is this actually going to perform?
Yeah. Have you ever let go of a property that you thought that was just a wrong decision at the start?
Yes. Yeah. I actually bought a block of land that was hurting me with cash flow. I had intentions to build, but plans changed, so I didn't. And I'm like, okay, now I can't wait for this thing to go up in value, so I've got to get rid of it. And I'm thankful that I did because it probably wouldn't have gone up in value.
Yeah.
But I did have to take a haircut on that. And I've had another property, and I've mentioned it for those long-term listeners. Thank you to all you lovely people. In Brisbane, one-bedroom apartment that's sat dormant in terms of growth for 7 or 8 years.
Yeah.
But in the last 3 or 4 years, or 3 years probably, has now decided to give me some growth and a bit of love. Now, I probably would have sold that earlier, much earlier, if it was giving me cash flow issues. But that was the positive of it, is it never gave me any cash flow issues.
Yeah, and that makes it very, very easy to hold.
Easy to hold. You almost forget about it until you bring it up on a podcast again. But in any case, no, that's a very good point. Now, what have I got for you? So cash flow buffers, equity. So I think for those people that are sitting there saying, do I use cash or do I use equity? Now, a different example to what I said before, because a lot of clients are saying to me now, I want to use equity in my home to buy the second property, which makes sense. Accountants saying use your equity, get some tax benefits, etc. Banks are saying, yep, that's fine, go and do that. However, as a result of that, your property is going to cost you 10 grand a year to hold. Versus using cash as a 10% or 20% deposit, my loan is less because I've used cash. So I'm only loaning 80% of the purchase price, for example. My loan costs are less. My running costs are less. Therefore, I'm not at a cash flow stranglehold as a result of having a lower loan.
Yeah, and you could have your cake and eat it too with that scenario. So you could use the equity in your property and borrow 100% plus costs for the new property.
Yes.
And you could have your savings offsetting that loan. So you're not contributing money now, but down the track, you might want to upsize your own home or do something else. You've got the ability to take that out.
Yes.
You might take that out when, if it's in an offset account, you might take that out when the rent goes up. You know, the rents are going to go up. They're not, and the debt's going to still remain the same.
Yes.
So eventually it's going to pay for itself. So at the time that it does, then you've got the luxury of taking that money out and putting it somewhere else that you want to put it. But if you didn't borrow that at the start, that's it. You can never have more owing against that property and for that to be tax deductible.
No. The only issue with that is if we don't use the cash and we use the equity and have the cash in the offset, the repayments are still the same, aren't they?
So if you were to do an interest-only loan, the repayments would be less.
Oh, okay, yeah.
So in an interest-only loan, you only ever pay on what's owing.
Yes. So, okay, let's use a real-life example so that the listeners at home are on the same page. So we've got a $500K loan and we're paying, I don't know, let's make up an amount, $2,500 a month in interest.
Mm-hmm.
Yeah. Now, because I've got $50,000 sitting in the offset, the interest I'm paying each month is only on $450,000.
Yep,
isn't it?
That's right.
So instead of paying $2,500 of interest, I might pay $2,200 a month, $2,200. I've saved that because I've got that $50,000 sitting there.
Yeah, so if you had an interest-only loan, the actual repayment would be adjusted. So
Yes.
an interest-only loan, the repayment's different every month.
Yes.
Because interest is calculated daily and it's charged monthly. But if that $500,000 loan, if for some reason you made that a principal and interest loan, your repayment, and let's say your repayments were $3,000 a month because you're paying P&I,
Principal, yep.
and $500 of that was, principal and $2,500 was interest. With that $50,000 offsetting, you would still pay the same repayment. You'd still
Yes.
pay the $3,000, but you'd pay more off the principal every month because the interest is less.
Interest less. So the $3,000 still remains, whereas the interest only, it doesn't. You pay it based on the interest that's payable at the time.
And if we can, we've got that interest only. We want those investment loans interest only.
Yeah.
For that exact reason there too.
And that's a double whammy, isn't it? Where you get that cake and eat it scenario. You're still using the equity,
Yeah.
which has squashed my desire to use cash
Yes.
as a deposit. However, if you're not buying another property soon, there's nothing wrong with using cash. If you don't want your principal place in the next 10 years because you've already got it,
Yeah.
then we could put down that cash and just have the lower repayments
Yeah, absolutely could.
if we're lean on cash flow in our personal life. Yeah.
Or if your borrowing capacity was impeded for some reason, you might need to put it in
Put in more.
to enable the purchase.
Yeah, absolutely. Okay. All right. That's pretty good, Rach. Is there any else? That's 6 good points that has been raised here. Is there anything else that you had to finish off with?
No, I would just say, if you are looking at getting into the market at this time with a 6, while the rates are at that level, I think it's more important than ever to get the right advice and buy the right property the first time. Yeah,
no, that is good advice in itself to get advice. But so recapping, repayments interest only instead of P&I.
Yep.
No-brainer for me in my world anyway. Pay-as-you-go instalments, they can be adjusted with your accountant.
Yep, not for everybody, but worth looking into.
Cash flow management, and make sure you know what's coming in and out in your personal life and you understand what's happening in your property portfolio as well.
100%.
Equity, grabbing some equity or a little bit of extra equity for the buffer.
Yeah, adequate buffers.
Yeah. Choosing the right portfolio. So if we've got a blank template to start with, we've got to have that balance of cash flow and growth, don't we? Or that neutral, ideally a neutral portfolio.
Yeah.
And then the final one is the flexibility to have a cash deposit if we need to reduce the loan amount so that you can manage that whole portfolio. Because when we're talking like 3 and 4 and 5 properties, there's a bit going on. So you may require to put some cash down just to get those LVRs reasonably normal or in shape. But more importantly, the cash flow. If we've got $2,000 per property bleeding from each of the properties on 4 properties each month, there's $8,000 going out. It starts to hurt a bit, doesn't it?
Yeah, it does't. It's got to come from somewhere.
Got to come from somewhere. It doesn't grow on trees, Rach. So thank you. That's been awesome. Hey, if anyone's listening in that wants to chat to a good mortgage broker, where are they finding the Sphere Home Loans team?
So you can reach out to us at hello@spherehomeloans.com.au.
Awesome. Love it. And unbeknown to a lot of people, you are located on the Central Coast, but you do interact with people nationally.
Yeah, so we've been a national business for about 5 years now, and mainly because of this community. We've expanded, and I guess COVID was an amazing time for us because it allowed, I guess, the banks to catch up with what really people wanted, which was the ability to interact online.
Yeah, love it. Yeah, and I think the days of having someone in person, like, it's great, but just the efficiencies of it are just no longer required anymore, are they?
Well, we have even clients that are based 2 minutes from our office would still prefer a Teams meeting nowadays.
Yeah. Actually, we had someone the other day come into our office or saying they were coming in. I'm like, whoa, better clean the joint up. Any case, good fun. All right. Once again, thanks for allowing us into your ears today. Until next time, take care.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold, or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the hosts, the publisher, or their respective license holders.